Auditing long-lived assets demands strict adherence to professional and ethical standards. These standards ensure the audit's quality, objectivity, and reliability. The Public Accounting Oversight Board, or PCAOB, sets forth auditing standards in the United States. These standards guide auditors in performing their duties with integrity and competence. Ethical frameworks such as the AICPA Code of Professional Conduct are crucial as well. They emphasize independence, objectivity, and confidentiality. Auditors must maintain independence in both appearance and fact. This means avoiding any conflicts of interest that could compromise their objectivity. Objectivity requires auditors to approach their work with an unbiased and impartial mindset. They should base their conclusions on evidence, not personal opinions. Confidentiality is paramount in safeguarding sensitive client information. Auditors must treat all client data with the utmost discretion. Professional skepticism is another cornerstone of ethical auditing. Auditors should maintain a questioning mind and critically evaluate audit evidence. They should not simply accept management's assertions at face value. Instead, they must corroborate those assertions with independent verification. Ethical decision-making involves considering all relevant factors. This includes potential conflicts of interest, the impact on stakeholders, and the long-term consequences of decisions. By adhering to these frameworks, auditors can conduct audits that are both effective and ethical. Their work will be credible, reliable, and in the best interest of the public. Auditing long-lived assets centers around key accounts disclosures and management assertions. These elements provide a roadmap for auditors to assess the accuracy and completeness of financial statements. Significant accounts include property, plant, and equipment, also known as PP&E, intangible assets, and natural resources. These accounts often represent a substantial portion of a company's assets, therefore their proper accounting treatment is critical. Disclosures related to long-lived assets are equally important. These disclosures provide context and transparency to users of financial statements. They typically include depreciation methods, useful lives, impairment charges, and capital expenditures. Comprehensive disclosures help stakeholders understand the company's investment strategy and the condition of its assets. Management assertions are implicit or explicit claims made by management about the financial statements. For long-lived assets, key assertions include existence, completeness, valuation, and rights and obligations. The existence assertion verifies that recorded assets physically exist. Completeness ensures that all long-lived assets are recorded. Valuation focuses on whether assets are recorded at their appropriate carrying amounts. Rights and obligations confirm that the company has legal ownership or usage rights to the assets. By understanding these accounts, disclosures, and assertions, auditors can develop targeted audit procedures. These procedures are designed to gather sufficient and appropriate audit evidence. Inherent risk, a fundamental concept in auditing, represents the susceptibility of an account balance or class of transactions to material misstatement. This susceptibility exists before considering any internal controls. In the context of long-lived assets, inherent risks can arise from various factors. These factors include the complexity of the assets, their susceptibility to obsolescence, and the subjectivity involved in their valuation. Long-lived assets often involve complex accounting standards and principles. Depreciation methods, useful lives, and impairment assessments require significant judgment. This complexity increases the risk of errors or misinterpretations. Technological advancements and changing market conditions can render long-lived assets obsolete quickly. This obsolescence risk poses challenges in determining the appropriate carrying amount of assets. Valuation of long-lived assets often relies on estimates and assumptions. Determining fair value or estimating useful lives involves subjectivity. Different judgments can lead to material differences in reported amounts. The inherent risk of material misstatement can be heightened in industries with rapidly changing technologies or volatile markets. For example, technology companies face a higher risk of obsolescence for their equipment. Understanding these inherent risks allows auditors to tailor their audit approach. They can allocate more resources to areas with higher inherent risk. Fraud risks in long-lived asset audits demand heightened vigilance from auditors. These risks stem from the potential for management or employees to misappropriate assets or manipulate financial reporting. Long-lived assets, due to their often significant value and longer lifespans, can be particularly vulnerable to fraud. One significant fraud risk is the improper capitalization of expenses. Management might misclassify expenses as assets to inflate earnings or meet financial targets. For instance, repair and maintenance costs might be capitalized instead of expensed. Another area of concern is the overstatement of asset values. This can be achieved through inflated appraisals, fictitious assets, or the manipulation of useful lives and salvage values. Asset misappropriation is another fraud risk associated with long-lived assets. Employees might steal or misuse company assets for personal gain. This can include theft of equipment, unauthorized use of company vehicles, or fraudulent disposal of assets. The risk of fraud can be elevated in organizations with weak internal controls, a lack of ethical tone at the top, or pressure to meet financial targets. Auditors should be alert to red flags that might indicate fraudulent activities. These red flags can include unusual accounting entries, inconsistencies in documentation, and reluctance by management to provide information. Section 5. Control risks in long-lived asset audits. Control risk, a crucial aspect of audit risk assessment, relates to the possibility that a material misstatement could occur and not be prevented, detected, or corrected by an entity's internal control system. Effective internal controls over long-lived assets are essential to mitigate this risk. These controls encompass a range of policies and procedures designed to safeguard assets and ensure accurate financial reporting. Authorization controls ensure that all acquisitions, disposals, and significant repairs and maintenance activities are properly authorized. This helps prevent unauthorized transactions and misappropriation of assets. Custody controls focus on safeguarding assets from theft, damage, or unauthorized use. Physical safeguards, such as security cameras and restricted access, are essential components of custody controls. Reconciliation controls involve periodic comparisons of physical assets to accounting records. This helps detect any discrepancies or potential misstatements. Depreciation controls ensure that depreciation is calculated accurately and consistently based on the company's accounting policies. Regular reviews of useful lives and salvage values are crucial for proper depreciation. Effective IT controls are also paramount, especially as companies increasingly rely on technology for asset management. These controls ensure the accuracy, completeness, and security of asset data and transactions. By assessing control risk, auditors can determine the nature, timing, and extent of their substantive procedures. Section 6. Preliminary analytical procedures for long-lived assets. Preliminary analytical procedures play a vital role in auditing long-lived assets. These procedures involve analyzing financial and non-financial data to identify trends, ratios, and relationships that might indicate potential misstatements. By performing these procedures early in the audit, auditors can gain a better understanding of the client's business and identify areas that require further scrutiny. One common analytical procedure is comparing current year balances to prior year balances. Significant fluctuations in long-lived asset balances, depreciation expense, or capital expenditures warrant further investigation. Auditors might also calculate and analyze key ratios such as the asset turnover ratio and the fixed asset to total assets ratio. Deviations from industry norms or prior year trends could signal potential issues. Comparing budgeted amounts to actual amounts can also reveal potential misstatements. Significant variances between budgeted and actual capital expenditures or depreciation expense might indicate errors or irregularities. Non-financial data, such as production levels or square footage, can be used to assess the reasonableness of depreciation expense or the utilization of assets. By performing these preliminary analytical procedures, auditors can develop a more focused and efficient audit approach. Section 7. Responding to identified risks in long-lived asset audits. Responding to identified risks is a crucial step in the audit process. Once auditors have assessed inherent control and fraud risks related to long-lived assets, they need to design and perform audit procedures to address those risks. The nature, timing, and extent of these procedures will depend on the assessed level of risk. For areas with higher assessed risk, auditors might perform more extensive substantive procedures. This could involve selecting a larger sample size for testing, using more reliable sources of evidence, or performing procedures closer to year-end. In some cases, auditors might need to modify their planned audit approach based on the results of their risk assessment procedures. If auditors identify significant risks of material misstatement, they should communicate those risks to the appropriate level of management and those charged with governance. This communication helps ensure that management is aware of the identified risks and can take appropriate actions to mitigate those risks. Auditors should also document their risk assessments and responses in their working papers. Effective risk response involves a combination of professional skepticism, sound judgment, and a thorough understanding of the client's business and industry. Section 8. Tests of controls in long-lived asset audits. Tests of controls are an integral part of auditing long-lived assets. These tests aim to evaluate the effectiveness of internal controls in preventing or detecting material misstatements. By testing controls, auditors can gain confidence in the reliability of financial reporting. The specific controls tested will vary depending on the client's environment and the assessed risks. One common test of controls is inquiry of client personnel. Auditors might interview individuals responsible for authorizing asset acquisitions or disposals to understand their procedures and controls. Another important test is observation. Auditors might observe the client's physical inventory, count procedures to assess their effectiveness in ensuring the completeness and existence of assets. Inspection of documentation is another crucial test. Auditors might inspect purchase orders, invoices, and receiving reports to verify that asset acquisitions are properly authorized and documented. They might also inspect maintenance records to assess the condition of assets and identify any potential impairment issues. Re-performance is a powerful test that involves independently performing a control procedure. For example, auditors might re-perform the client's reconciliation of subsidiary ledgers to general ledger accounts to assess its accuracy. By performing these tests of controls, auditors can gather evidence about the operating effectiveness of internal controls. Section 9. Substantive audit procedures for auditing long-lived assets. Substantive audit procedures are the cornerstone of auditing long-lived assets. These procedures are designed to detect material misstatements in account balances and disclosures. They involve obtaining direct evidence about the existence, completeness, valuation, and rights and obligations related to long-lived assets. Confirmation is a powerful substantive procedure used to verify the existence and ownership of assets. Auditors might send confirmation requests to third parties who lease assets from the client or hold assets on consignment. Physical inspection is another essential procedure, particularly for tangible assets. Auditors might physically inspect assets to verify their existence, condition, and location. Vouching involves tracing transactions back to supporting documentation. For example, auditors might vouch additions to property, plant, and equipment back to purchase invoices and receiving reports to verify their occurrence and authorization. Recalculation is a crucial procedure to ensure the accuracy of calculations. Auditors might recalculate depreciation expense, amortization expense, and impairment charges. Analytical procedures can also be used as substantive procedures. For example, auditors might compare depreciation expense to prior periods or industry averages to assess its reasonableness. By performing these substantive audit procedures, auditors can gather sufficient appropriate audit evidence to form an opinion on the fair presentation of long-lived assets in the financial statements.